Hey everyone, and welcome back to the Velocity channel. Listen, this is your bridge to financial freedom. Listen, happy Independence Day, everyone. Today, we're going to demystify velocity banking, and we're actually going to guide you all the way through it step by step. And we're going to break it down fifth grade style, all right? If you're new here, don't forget to subscribe and hit that notification bell so you don't miss any future videos, all right? Are you ready? Listen, let's dive in. First, we got to understand something, all right? What velocity banking is. What is velocity banking? It's a financial strategy that can, doesn't have to, but can use a line of credit to pay off debt faster by leveraging that difference in interest between your line of credit and those loans. Now, does that sound complicated? Don't worry, I'm going to break it down. Let me give you a scenario right now. So when I say that the difference lies in between the difference between your income and expenses, and that's what pays your line of credit down, I want you to realize what I'm talking about, okay? So when you have your income, right, that goes into your line of credit, let's say, right, and then of course from your line of credit, you're going to be spending your expenses. Whatever is in your line of credit, let's just say $2,000, right, and you have a $12,000 balance, okay? That $2,000 is going to be staying there. What is that $2,000 doing on the line of credit? Can't we use that? Why do we need that $2,000? Well, that $2,000 that's there is going to be paying your credit card off. This is what I mean. If you have a $12,000 balance, okay, you divide that by your cash flow, which is staying where? In your line of credit. Now, you're dividing the 2,000 by the 12,000. How many months are you going to pay that card off? Without getting a second job, without taking a second mortgage, without all of these other things that you have normally done, right? How many months? Cross out these zeros. 12 divided by 2, which is 6 months. It's going to take you 6 months to pay off something that before took you 4 years. Remember, folks, $2,000 or that cash flow that's left over inside of your line of credit is what's paying it down. And many times it's more than your minimum monthly payment, which means you no longer have a minimum monthly payment. Let's keep going. All right, so now let's talk about the steps to master velocity banking, okay? Yeah, I'll wait. Go ahead and get your stylus out, get your pen out. Number 1, identify your loans and their interest rates. Number 2, open a line of credit if you can. Now remember, the interest rate should be lower than your loans. Okay, and we're actually going to go ahead and give you an illustration. Step 3, use this line of credit to pay off your loans. Let me give you a demonstration of that right now. All right, let's go ahead and dive deep into the steps. Step number 1, you have to identify your loans and their interest rates. Let's go ahead and give you 3 examples. So we have a $25K car loan, all right? That's at $600 each month. Then we're going to have a credit card, which is, let's say, $15K, all right? And let's just say that one is at $700 each month, okay? And then we got a mortgage, $200,000. Let's just say that one's at 6%. So at 6%, it would be around what? $1,199.10, about that. Okay, let's just round it up to $1,200 each and every month. Right? Let me show you how to identify these loans and their interest rates, right? But I want to show you a better way, which means we're going to prioritize the elimination factor. We're going to prioritize it. And how do we do that? By the cash flow index. Let me show you. All right, so listen, up to this point, I have not talked about interest rates because I'm going to redefine what interest rate it actually means. And this is what I mean. Look at this. We got the $25,000, $600 each month. Look, 15K, 700 each month, 200K, $1,200 each month coming out of our pockets. Now, how do we prioritize this? We redefine interest rate. From now on, I want you to think of interest rate like this. What is your rate of interest in terms of what loan would you like to pay off? And you're not going to do this in your mind. You're simply going to put the numbers in the calculator, meaning you're going to calculate the cash flow index method, which is the loan balance. Well, that's what the LB stands for. Loan balance divided by the minimum monster, right? The minimum monthly payment. And when you do that to each of these loans, you will then have the number that says, pay me off first. Now, of these numbers, which one would you pay off first? 42? This one. 22? This one. Or 167? This one. Do you remember what the cash flow index method is? That's right. So when you're dividing, you get numbers. The lowest one is increased on your rate of interest. That's the one that you are highly interested in paying off first, okay? You're going to be paying this one off first. Why? Because look at how much you're paying out versus how much you obtained or got the loan for, right? You got $15,000, but you're paying $700 for it, okay? Let me show you about the comparison. $200,000, $1,200 each month, right? But you're getting $200,000, right? You got the house, you're paying $1,200 each month for it. According to the numbers, that's how you make the decision. According to the numbers, that's an excellent loan. It's an effective, what we call an effective loan, okay? Closer to zero that you get on the loan, right? The loan bar or the cash flow index bar, that's the least effective or the ineffective loans, all right? And that's how I define or we define interest rate. What loan are you interested in paying off first, right? It's going to be the one that is the lowest, the one that's sucking the most cash flow from your bank account. Let's move forward. All right, in this part, I'm going to try not to confuse you, but I want to show you how to turn a $5,000 purchase into only $250. There's nothing special. There's no discounts or anything that you have to do. I just want to show you your true cost. Is that okay? So check this out. Say you got the credit card, because, you know, if you can't open a line of credit, I recommend doing it, right? So let's say you opened a line of credit at $20,000 at 20%, right? But right now, remember, this is unsecured. This is an unsecured line, right? So it's not your money. Oh, I gotta say that again. I said this is an unsecured line, so it's not your money. Someone trusted you because they saw your score and everything. That, hey, you know what? Let's go ahead and give this person a $20,000 line. It's not your money, right? Let's say, hey, you know what? I need to purchase this, that, and the other, right? Something for my education. I want to know more about real estate. I want to know about more velocity banking. I want to know more about, you know, how to sell cars. Whatever it is, $5,000 purchase, right? $5,000. So that's 5,000 at what? At 20%, okay? So we're going to multiply, aren't we? We're going to multiply this by this. How much is it going to cost you? $1,000. Remember, because you are placing your income inside of this, right? And your expenses are getting paid from this. So let's say you have $5,000, right, in income, $3,000 in expenses. The only reason why I use that is because that's the national average. So look, $5,000 comes in, $3,000 goes out. Remember, we already covered it. $2,000 is staying in the card. What's your true cost? Because you're using someone else's money. So $5,000, right? $5,000 is your balance now. But how much are you paying for that education? How much are you paying for that product or that service? If you took 3 months to pay off this card or this line of credit, your true cost at this amount is actually $250. Why? Because that is this in dollars. That's what 20% is. So you're only out $250. You're not out $5,000. You want me to prove it? Can you pay for your next meal? Can you still pay for your expenses? So what changed? Your mindset. That's what changed. Let's continue. Now, there have been people that have let me know, hey, CJ, what's up, man? The bank is not letting me put a direct deposit directly into my credit line. Why is that? Well, because the bank has not woken up yet, okay? It's not awakened to the fact of velocity banking as of yet. Some are. And many of you know what I'm talking about. First-Lien, HELOC, all this, we got the description down there below, right? Many got integrated checking accounts. They are all that in a bag of several potato chips, okay? But I want to show you, for now, this is the way you're going to move your money, all right? This is how it's going to be allocated, right? With that word being located, okay? Let's do this. We have the income, right? First, it's the I, right? Income comes in, right? Where are you going to put it? You're going to put it inside of, I say, your old checking account. Some would like to go into their DOA accounts or IRA accounts, right? And that's okay, right? Dead on arrival. Why? Look at the stock market. Oh yeah, but it's going to turn around. It's going to turn around. Listen, you can turn around way faster when you know how to move your money. Checking accounts, right? And then from your checking account, where's it going to be? Then you go inside of your line of credit, whether that's your credit card, whether that's your business line of credit, whether that is, you know what I'm saying? You go inside of the line of credit. And then from that line of credit, from that velocity banking line of credit, from that designated line of credit, you then pay your bills, okay? Which can mean your loans, right? Which can mean your expenses, your groceries, whatever it is. That is the cash flow model, right? That is the way we move our money within the velocity banking method. So this is what I want you to do. I want you to go out and get a line of credit right now. Get a line of credit right now. If you have trouble with that, let me know. Please, let me know. There's a fella, and I gotta give him another shout out, credit plug, He's let me know, man, this is better than Navy Federal Credit Union, Langley Federal Credit Union. Hey, check that one out. I know my clients, man, they benefited greatly from PenFed Credit Union. And no, I'm not getting paid to say that, right? They're just good banks, and I want you, or credit unions, and I want you to have even more, right? Even more. And so, folks, if you have any questions, concerns whatsoever, let me know. And we'll get to the bottom of it, all right? God bless, and you guys have a great night.